Welcome to Investors Insights, where today's topic is government shenanigans. So a lot to talk about today. So before Ty talks about a potential government shutdown and Trey gives an important update on inflation coming out this week, I want to first talk about the election. We are continuing to get a lot of questions about market worries due to the political questions and the election. There's no doubt that election noise is picking up, especially with Super Tuesday coming up next week on March 5th. As always, no guarantees with market performance, but I want to share two charts that show that some of the worries might be overdone at this point. And so this first chart, it shows the average performance of the S&P 500 index in presidential re-election years seen in the dark blue line, and the average open presidential election performance at the bottom in the light blue line. Historically, the market performance is better in re-election years. And the reason for that is that the market knows the incumbent's policies. This year, there's no difference as the market knows the policies of the two frontrunners. Now, anything can happen between now and November, but we'll see. But there isn't a lot of uncertainty. And that is why, since 1960, the market has historically performed better in re-election years. And this next chart shows that the S&P 500 is tracking closely in line with the average performance in previous re-election years going back to 1964. So looking at this chart, it wouldn't be out of the ordinary to see some volatility in the next few weeks around Super Tuesday, but the average performance has historically been positive, again, in re-election years. It's something we'll continue to keep you informed on. And so, Ty, again, government shenanigans was the topic today. Talk about what's going on in the potential government shutdown that we're looking at.
Yeah, if you remember, late last year, the government passed a short-term continuing budget resolution that would allow for government funding to continue into this year. Congress is coming back from recess this week, and top of mind will be 4 appropriations bills that are set to expire: agriculture, transportation HUD, energy, water, and military construction. And so with that being said, I think they want to try to avoid another short-term continuing resolution. I think they would prefer to have something a little more long-term. But that's something that's going to be on the docket as soon as today. The deadline to get that stuff passed is Friday, March 1st. That's when those appropriations bills expire. And so, I have a chart here. If you see the odds of a government shutdown, this will be a partial shutdown, kind of increasing here over the last couple of weeks. And that's something that we're keeping an eye on. Again, probably won't be a huge factor in the market overall. But with that being said, it's something that will obviously dominate the news and dominate headlines for the next couple of weeks.
Yeah, that's great. And then, Trey, we've got a really important update on inflation this week. Again, this market is driven by the Fed policies and what the Fed is expected to do. And this week, we'll get an important update. Talk about that.
Yeah, thanks, Bobby. So for longest time, as market participants, we typically focus on one inflation report. That's Consumer Price Index. And then some participants like to look at core Consumer Price Index, which takes out food and energy. Through this inflation cycle, we've learned a lot of different gauges on inflation. PPI, which is the Producer Price Index, a lot of economists like that. And then we've also learned that the Federal Reserve, or at least this Federal Reserve, likes to look at PCE, which stands for Personal Consumption Expenditures. That is their preferred inflation gauge. Now, I don't know if that's their preferred inflation gauge because it's more accurate or because it's been lower. I'll leave that for them to tell us. But anyways, this week we're getting PCE out, and it's expected to come in around 2.8%. We again expect it to be higher than what the market's expecting. But this is the last really bit of large inflation news that the camp that expects the Fed to cut rates has been holding on to. That CPI may be higher, PPI may come in higher, but PCE, the Fed's preferred inflation gauge, will come in lower. And so we feel like it's going to be a very large market moving event. If you look at what happened on the CPI report day and PPI report day over the last few weeks, market fell combined 1.85% on those days. So definitely market moving events. It's really what is focusing on interest rate policy, and the S&P is moving off that interest rate policy. Something we're watching closely. Some bit of shenanigans around which one is your preferred. We prefer not to try and pick and choose. We prefer to look at all of them and try and take an average or a headline. But regardless, it looks like across the board, inflation is coming in a little hotter than expected. And so we, again, continue to think that the rates are going to remain higher for longer. This will be a big data point to look at.
Yep. So a lot going on as always. So if you have any questions about anything we've talked about today, please call us, email us. We love to hear from you. And have a great week. We'll see you next Monday. Thanks.